Good morning, ARMR Insiders. Welcome to the morning meeting. Thank you all for joining me. Let's get our day set up, decide how we want to be trading and what our investing posture is. So the whole point of the ARMR report here is to share information and illustrate how to use it, right? That's what we're trying to do. Just what's the information? How are we going to use it? That's how I want to have these conversations with you. So we had a big day yesterday at the ARMR report. Okay, we're building alpha. We've been building alpha all year. We've been doing that because we are following the ARMR investing way. It's a three-stage process, not hard to understand. The information I'm trying to provide is really just trying to get rid of all the noise out there and just focus on the information that can protect capital or make us money. So December 3rd, the risk monitor goes red. That's our own proprietary algorithms that we designed for the top 7 indexes, telling us when to commit capital or when there's something not right about the market and it's time to protect capital. Okay. So we've been building up a cash position and carrying a lot of cash, for almost 2 months now. And of course, that's what's creating alpha for us. When the market goes down, you have a ton of cash, you have alpha. We don't stop doing the research. So, I just love uncovering new investment ideas and doing research. And that's what the whiteboard's for. And when the market environment changes and the risk monitor goes green, we will go to the whiteboard, figure out what stocks are best positioned to make us money, and we'll fill out the portfolio, put our cash to work. But the information this morning, from an investing point of view, is that we remain risk monitor red. We follow options closely. We use spot gamma to do it, right? So we're in a negative gamma environment. So you got to really understand what that information means. During the bull market from 2020 right to the end of 2021, I guess till December, we lived in a positive gamma environment constantly. And in that type of environment, you'll get some selling during the day, and then you'll get the options behavior that just drives the market higher, grinds the market higher, grinds it higher. But so you've got to understand when that grinding higher has changed. Risk monitor red helps. That happens first. First, you get risk monitor red, and it tells you something's not right in the market. Then you see the market start heading lower, and you get this negative gamma feedback loop. And what you get are sell-offs in the afternoon instead of rallies. And that's a bear market, right? So by the time everybody on CNBC tells you it's a bear market, the bear market will be over, right? So don't get hung up on the terminology, bear market, correction, all that other baloney. That's just a bunch of that's just what the magicians use, to try to keep you long the market, okay? All those terms and don't worry, you're not in a bear market yet or whatever. The market is getting wrecked, people. We all know it at the ARMR report. We've avoided the wreckage. We've got a ton of cash. So what happens today? There's nothing to add to our portfolio. How do we use this information? Risk monitor red, negative gamma environment. This is not an environment for us to be saying to ourselves, let's try this idea, or let's take a shot at that name. That works in a positive gamma environment when the risk monitor is green or yellow. It doesn't work. And in fact, it's destructive in a risk monitor red, negative gamma market. So now's the time to just sit back, relax, husband cash, and wait. You don't have to be the first one into the breach. You know what usually happens to the first soldier into the breach? He gets cut down, right? We don't have to be that first guy into the breach. It doesn't matter if we happen to miss the bottom by a day. What difference does it make? Not to mention the fact we won't know that until retrospect. So, and this is the thing that really disturbs me the most about when the Fed adds massive amounts of liquidity. It makes particularly new investors, it completely puts the wrong what am I trying to say? For new investors who get started in 2020 and think the market only goes up, they now have no skills to deal with the market we're having today. And this is a major, like this market cycles like this. So you've got to build your skills to protect capital so that you can be there to make a lot of money when the next cycle starts. And all the Fed largesse, all it does is create a mindset where people think stocks only go up. I don't need risk management. I don't need to protect my capital. There was that whole diamond hands movement, which was ridiculous. I just, it pains me to listen to people pretending that there's diamond hands when they buy any assets. Whoever's telling you to have diamond hands, I guarantee that individual is dumping stock, right? They come out and tell you, diamond hands, hold on, drive the asset higher so I can dump it. It's like a classic Ponzi scheme. I mean, it happens over and over and over again down through the centuries. So I'm getting off on a tangent down a rabbit hole. So let's bring it back to today's market. Risk monitor red, negative gamma, huge down day yesterday, especially selling right to the close. So we expect the gap up this morning. That might happen a little bit. So let's shift over to how we're going to trade today, because we know from an investing standpoint, there's nothing to do. We're not changing the portfolio dramatically, although I will talk about precious metals in a second. Okay, that's the bright spot. Let's look at a couple of things in the market to crystallize this conversation so you understand why I'm so negative. And then we're going to look at the day trading setup. All right. So this is a classic bear wedge, and I've been talking about this the last few weeks. When a bear wedge breaks, it gets really ugly. So it's clearly broken. You can see it broke here, but then it recovered on the Dow. This is the Dow we're looking at. This is the daily chart of the Dow. So it broke here and recovered, tried to break, can't, right? It's more of a rising wedge. Now it breaks again. It's right at the 200-day moving average. So of course the hope is that it holds the 200-day. But the problem is I don't invest with hope. You know, when you're hoping, you should be afraid, and when you're afraid, you should be hoping. Okay? This is what happens when a rising wedge breaks. It looks like this. The risks go up exponentially when a rising wedge breaks. Here's the momentum index. And so now we go back to the Dow. Okay? So the risk goes up exponentially when a rising wedge breaks. And at the ARMR report, and we all should be in the business of doing this, and this is what we do at the ARMR report, we put capital to work when reward is worth the risk and probabilities are in our favor. So when you have a risk monitor red, negative gamma environment, probabilities are not in your favor. But more importantly, the reward to risk is, put on its head. The reward to risk. You might have a day or two where the market goes up, but the risk of what happens when the bottom falls out of the market is it makes that equation it makes the equation impossible. You can't possibly put money to work if you care about reward to risk. And so I just wanted to walk you through that progression because you can see what happens. Rising wedge, the Dow just broke it. This is the last leg of the market to hold the market up. These are the industrial stocks. And they're going to follow the innovative stocks. I mean, you've been hearing me say this for the last 2 months. I've never in my life seen innovative stocks get destroyed. And let's be honest, they're down 50+% off the highs now. It's insane what's going on in those stocks. I've never seen that not lead to a bear market. I've never seen it. And we don't have to put that term on it. Let's just say this. I've never seen it not create a serious drawdown for the rest of the market. Let's call it that. So we don't get caught up in what a bear market is and what it isn't. Okay. Momentum stocks are imploding, which are the big cap, tech stocks. Of course, we already know. Let's take a look real quick at the Nasdaq. I just wanted to go over this with you so it puts in perspective the thought of, hey, should we be buying the Nasdaq because it's on the 200-day? I mean, can the market go up for a couple of days because the Nasdaq is on the 200-day? Sure. The market could go up for a couple of days for any reason. And don't forget that. We talked about this I think last week maybe. In any downtrend, you can have a 2-day rally, and they could be scorchers. but it means nothing. It's just a classic, usually options fueled rally. The puts are all of a sudden, there's so many puts in the money that people who own puts sell their puts for a couple of days to book their profit, and the market rips higher. But that doesn't change the overall trend. We don't want to be the suckers who buy the market because it's up a couple of days. We need a real bottom to form, and the ARMR, in all humility, the ARMR Risk Monitor will help you with that because it looks for confluence across indexes. That's the footprint of institutions putting money to work. Risk Monitor Red doesn't mean the market has to crash, but what it tells you is there's no confluence. There's just complete movement in every different direction. Some indexes going down, some going up. That's the best case scenario, which usually leads to the market we're in now, which is a market that goes down aggressively. Okay. So this is the Nasdaq. So I won't be buying the Nasdaq just because it's on the 200-day. That doesn't work for me. What we have really is a huge uptrend that's now in the process of breaking. And then we'll just wrap up with this picture right here of the small cap index. As you know, I always say this is the canary in the coal mine. It's been telling us, in this particular case, it didn't really help, right? It was making this huge top, for 12 months, but the market was going up. So it took forever for this to finally break out and fail. But that breakout failure, that was the canary. I make that yellow because the canary died right there. Small caps consolidated. That's just a consolidation. That's okay. Break out and immediately fail tells you that the coal mine is about to explode. The canary popped out and died. And now it's broken down below that 12-month top. You can see why I'm not that interested in being the first soldier through the breach just because the market has an up day. There's a bigger picture here at work, and it's not pretty. Now let's skip over to what is pretty and what we will be doing today. So I'm going to throw my hat in the ring. I did it yesterday. I put it all over Twitter, and so everybody can make fun of me over the next couple of days and weeks when it doesn't work. Okay? Because, my hat's in the ring. Yesterday marked the beginning of the next significant leg higher in precious metals. There, I said it. I know it's crazy. We've been hawking this position and waiting for this move for months. We've tried a couple of entries that have failed. I get it. But the best money managers don't, just like the best goaltenders in hockey, we don't remember what happened last night. You get scored on 8 times last night. You got another game to play. You don't come in worrying about it. You just pitch a shutout. So it doesn't matter that during the last 12 months, gold has had a consolidation and been in a downtrend, and you've had a couple of starts that have failed. It doesn't make a difference. We made a lot of money in this group in 2020. We traded it successfully in 2021. We had a couple of entries that failed. So what? The question is, what's going to happen next? And I'm just telling you, after 30 plus years of trading, and really we've had a focus of trading precious metals since somewhere around 2005. I was actually managing a precious metals hedge fund where all we did was focus on precious metals investing. That's what my dad and I were doing. We had a couple of hedge funds, and one was just geared towards precious metals. All right. So I've been here before. And when you're right on precious metals, you make a lot of money and it's a lot of fun. And the behavior of the metals in the last few weeks leading up to yesterday's blowout is something I've seen before, and it usually leads to dramatically higher prices in the near term. Now, I'm fully aware precious metals like to make fools of us most of the time. So the whole thing can reverse and implode tomorrow, and I'll say, mea culpa, it didn't work. I don't know. But I'm just telling you, the chart patterns are there. The algorithmic entry points are there. We bought closest to the stop. It hasn't even started yet. Gold needs to pop out of the downtrend. That's how early we are. So we own Sprott Physical Gold. We own Sprott Physical Silver. Silver's leading gold. That's step one. So when I say to you, I've been doing this a long time, and what do I know from all I've learned? You need silver to lead gold. You need the metal stocks to lead the metal. They need to come on and blow out. Hasn't even started yet. That's why I wrote here, day one. Day one. This is the bottom. That was the blowout. We had the 3-bar reversal, which we highlighted, and then a test of that. It held. Yesterday morning, we were buying NUGT and SILJ to finish off our gold exposure. We have 25% of our portfolio in precious metals now. Okay. I could bump it up to 30%, depending on, if I get a shot. I'm not going to pay up for it. There'll be some down mornings. And the object now is to, if you want to increase your portfolio exposure, is to use the down mornings. I was telling everybody on the trading desk yesterday, you got to have your position on that you're happy with. Chances are it's going to gap up tomorrow morning, which it's doing right now. Okay. So it's probably going to gap and run away. And what I'll do if I want to add to my position is it'll run away, let that happen, then it'll sell off. Look, it will not be easy in the metals. There'll be this blowout, then there'll be that gut-wrenching shakeout. Okay, but the tide is turned here. So instead of the shakeout being gut-wrenching, that'll be a time where I might want to add my last piece if I want it. I mean, I'm content at 25%. When we started this year, I said to you, I wouldn't put more than 20% of my assets in any one sector. And I'm at 25% already. So, 30 would be max. So I might sprinkle a little extra. The way I'm doing it is through these 4 ETFs. The answer to your question of what about this stock or that stock, they all look good. Okay. The stock that I bought, that we added to our portfolio, really, we added this to our dividend portfolio, is Newmont. And you can see Newmont is dramatically outperforming the GDX ETF. Like GDX is down here, just now breaking out, and Newmont is clearly leading the pack. We bought it; it was paying 3.8%, and they have a policy of increasing the dividend yield. So we probably are going to get more than 4% in dividends on Newmont. Gold-backed dividends in a gold bull market. This is going to be golden investment. Volume coming in. So, yes, there's many great names. You can do it however you want to do it. These things have just gotten started. Yesterday was the first day for Mag Silver, right? Hecla just broke out. And it hasn't even broken out yet. This is just a double bottom with the first up day. So, I won't be chasing anything. There's no reason to. We have enough exposure as it is. So if we want to add, we have to add on weakness in the morning, selling in the morning. It brings it down to a level. Boom. Then we can add, and we can either do it by increasing the exposure to the stocks that we already have, or sprinkling, some of our favorite names in there. Oil, gold. These things haven't gone anywhere yet. They've just started. That's why I said yesterday was day one of the move. Okay. So to wrap up our day trading posture, let's just go over real quick how we're going to be trading the indexes again today and every day. Trading the indexes. We were probably, I don't want to sound arrogant, but there was only one hour-long period where you can make money trading from the long side yesterday in the S&P and the Nasdaq. And we made that money on the ARMR trading desk. Okay. And we made it because we follow a simple rule. And I'm going to pound this into my head, and I hope it helps you. Okay. Because I don't want to ever miss these trades. We look for a crazy Ivan sell-off that lasts for at least an hour. This is the setup for us. So coming into today, what's going to happen with the market? Big down day yesterday, gap up in the morning. So what we look for, the ARMR Day Trading playbook on indexes now, is to look for a test of the low that holds and we get long. We look for the test to come down to some key support area. Sometimes it's gamma level, sometimes it's an ARMR PMP level, and then we look for really one of 4 reversal triggers, and I'll go over what happened yesterday here. So market gapped up yesterday, trades sideways, breaks down, sells off for an hour and a half. We buy that green box, this bar right here. It rallies up to and through VWAP. We book some profits at VWAP. We raise our stop to the VWAP. When it breaks back below right here, we book all of our gains, and then the thing imploded. In a risk monitor red negative gamma environment, when we were booking our gains long, we could have gone short. I chose not to do that yesterday, and I had to leave the desk early, take care of a family matter. So I didn't get short. But there, in a risk monitor red negative gamma market, there's 2 trades a day. The long trade that makes you some money and the short trade into the close that makes you a lot of money. Okay. This is the opposite of a gamma, a positive gamma risk monitor green yellow scenario where there's really 1 trade a day. Crazy Ivan, you buy it and it just goes higher and grinds higher all day. All right. So you have to have different sells, not different, but you have to make sure you follow your sell rules when it comes to this type of environment. You buy it here, it pops up, you book some profits on the way up, you raise your stop. If this was the day that was going to skyrocket, it would have never come back below VWAP. It would have just skyrocketed and we would have made a lot of money. Instead, we make a nice amount of money. The only money to be made long yesterday. Right? And now we wait for the same setup again today. And there's 4 buy triggers. The one that was yesterday's buy trigger was the double bottom higher low that occurred at the key location for us, which is the ARMR average true range low of the day. This was the first higher low, higher high of the hour and a half long sell-off. That's the trigger. Higher low, higher high. That's the entry point. First higher low, higher high of the hour and a half long sell-off. You get long there. The stop is a new low on the day. Book your profits when it runs. Okay? So we'll be looking for that again today in some form. It doesn't have to be the ATR low of the day. It'll happen wherever it wants to happen. It could be prior day's low. Sometimes it holds that level. Could be down at a key gamma level. So we'll just be sharing the information live on the trading desk, step by step with you. When we see it, I'll talk you through what I'm doing, and we'll all capture alpha again today. All right? So if it's there to be captured. If the market just gaps up and skyrockets, I don't play that day. Actually, a gap up that rallies in the morning, I look to short that. If it gaps up and actually goes up and then sets a top over an hour period, I look to short that breakdown. Okay? So that's the day trading setup. I hope you all have a great day of trading. Be safe out there. Be patient. And the word or the phrase of the day is protect capital in this market. Okay? Take care, everybody.